Hi, this is James Shrug with Westpac London's end of day report for Friday, May the 3rd. Apologies for not doing a report yesterday. It just was physically impossible given other commitments, and in fact there won't be one on Monday either because it's a bank holiday here in the UK. But I'm here today, and it was really a one-story day too. That's the US non-farm payrolls or jobs report that came out stronger than expected. The April number was 165,000. That was the increase in payroll employment, and there were upward revisions of 64,000 and 50,000 respectively to February and March figures. So the overall picture looked like one of clearly better than expected employment growth, given that other signals of the labour market, such as the ADP private payrolls measure on Wednesday, had been somewhat softer, and some of the jobs components of business surveys as well. There's still a clear slowdown in jobs growth in place since earlier this year. I mean, in January and February, the average gain there was 240,000. The average gain in March and April is now just 152,000. So there has been a slowdown, but it's from a higher starting point. There was some other detail in today's report for April that was a bit soft. That was the hours worked were down 0.4% in April. That follows in March a flat hourly earnings story. So there's still some evidence that household income is being constrained, either on the earnings side or the hours worked side, but certainly the overall bias of today's report was one that pleased markets. The unemployment rate fell to 7.5% from 7.6%, and unlike in the previous 2 months, there wasn't a decline in participation in the labour force, and there was actually a fall in unemployment that was some of which seems to have been mopped up by increased jobs, whereas in the March figures certainly the decline in unemployment was simply caused by people leaving the labour force altogether, and so not being counted as unemployed. So mostly a good report, just with that, a few caveats on some of the detail. The other news in the US was not so good. We saw the ISM non-manufacturing index fall 1.3 points to 53.1 in April. In fact, this survey has now fallen 2 months in a row, from 56 to 53.1, almost mirroring the similar fall from February last year, when it took 4 months to fall about the same amount, about 3 points. And there may be a bit of seasonality impacting on this series, as with some other series in the US, but there does seem to be some underlying weakness showing up in not just that survey, but the ISM factory survey and a lot of the regional surveys of late. However, it was the payroll story that really grabbed markets' attention, even if there are some warnings here that the economy is actually slowing. Other developments today: the European Commission published revised forecasts for a whole range of things, but the ones I'm going to focus on are economic growth, because they shaved their forecast for next year just 0.2%, from 1.4% to 1.2%. That's 2014. They're expecting the economy to grow after contractions in 2012 and 2013. We're pretty close to their minus 0.4% forecast for this year. We think it's going to be down a bit more than 0.5%, but we agree it's going to contract. But we think there's going to be ongoing contraction next year. The main difference between their forecast and ours is that they have the assumption that recently sharply lower bond yields in peripheral European government markets are sustained, and that we don't see any renewed blow-up in the European sovereign debt crisis. There are assumptions that have been proven to be incorrect each year they've held them so far. In 2011 they were forecasting growth in 2012. In 2012 they were forecasting growth in 2013. But they were, because of those assumptions largely, those assumptions were wrong. We think they'll probably be wrong again this year, unfortunately, for next. So that explains the difference between our ongoing recession forecast and the European Commission's apparent optimism that the recession will end. They're the main stories today. The services PMI in the UK actually was stronger than expected, rose from 52.4 to 52.9, and given that the construction and manufacturing surveys were less weak than expected, there's a bit of evidence there that maybe the UK economy is doing relatively better than Europe, even or can continue to grow at least, even if the Eurozone is in ongoing. The French market up 1.25%, the German market up almost 2%, Spain's up 1.5%, Italy's up about 0.9%. For all those markets, they were pretty much flat until the jobs figures came out in the US. So that gain was very much reflecting, comfort with the idea that the labour market isn't slowing too much in the US, or as much as had been expected. The Dow at the moment is up 1.1%. The level there is just over 15,000. Okay. In commodity markets, well, copper certainly has benefited from the decent jobs news. It's up 6% today. Oil prices are up 2%, $96.03 a barrel. And gold has not participated in this. It's down 0.2% at $1,465 an ounce. Maybe it's lost a little bit of its safe haven status today. The Aussie dollar, it's at 1.032 against the US dollar. It jumped, well, pretty much 0.5% on the US jobs numbers because of the implications, I suppose, for global economic growth if the US economy is doing a bit better. Okay, that's it for today. I'll be back, as I say, on Tuesday, and of course we'll have the Reserve Bank of Australia's decision on interest rates then. Westpac expects rates to come down in Australia, although we still June cut than May, but it's going to be a close call. Okay, I'm back next week.